Let's get right to it. The entire operational objective is to stop chasing direction and to start selling overpriced volatility. This is the core distinction, really. It's the fundamental split between how institutions operate and how retail thinks.
Look, the edge isn't in prediction. It's not about being a fortune teller. It's about identifying where the positioning is stacked up and where implied volatility is rich. That's it. The whole operation is simply to sell time against those key levels.
All right, Section 1, the institutional edge. Here we're going to lay out the system for identifying and then executing on a clear, probabilistic advantage. This is all about a repeatable, data-driven protocol.
Now, Section 2, mapping the environment. We always start with surveillance. We're looking at positioning and volatility. Before a single trade structure is even considered, the environment has to be mapped with precision. Think of this as the intelligence gathering phase of the operation.
Every single operation needs a green light from this intelligence checklist. These are non-negotiable. First, you have to identify the positioning walls. Second, you assess the dealer gamma regime. You need to know what the stability looks like. And third, you measure the implied volatility. Are we actually getting paid to take this risk? If you don't get a yes on all three, it's a no-go.
So what are these walls? Well, they're basically institutional magnets. Call walls are like a ceiling. They cap the upside potential. Put walls act as a floor, defending the downside. Now, when both are heavy, that's when it gets interesting. They create a really defined range, effectively boxing in price action.
The target for implied volatility percentile is pretty specific. It has to be above 70. Why? Because above this threshold, options become structurally overpriced compared to their likely actual movement. It means we're being paid an excess premium to take on a very defined risk. This is the primary trigger for the whole operation.
Okay, Section 3, structure and execution. The environment's been mapped, the conditions are met, now we move to the Iron Condor protocol. This part is all about the details of trade construction and precise execution. The structure we're deploying is the Iron Condor, but we don't see it as some textbook trade. We view it as an institutional tool. The protocol is clear: sell a call spread above that call wall and sell a put spread below the put wall. The objective here is not to predict where the market is going. The objective is to sell probability.
So where does the profit come from? It's driven by three distinct forces. First, and most obviously, time decay. That's our theta. Second, a contraction in implied volatility, which is our vega exposure. And third, and this is important, the gravitational pull of those big positioning walls. They really act like a containment field for the price. Execution has to be precise. You place the spreads outside the market's expected move, you collect the credit. But the real key to this entire system is the exit protocol. We do not hold to expiration. I want to be very clear about that. We close early, targeting 20 to 40% of the maximum possible credit, and we're usually out within 1 to 3 sessions. The goal here is small, consistent, repeatable wins. Section 4, the risk transfer protocol. Now we get to the most critical component of all: institutional defense. This is the protocol for managing the position when and if the thesis gets challenged. This is truly what separates institutional execution from retail.
So this is the crucial question, right? What's the standard operating procedure when one of your short strikes is tested? The answer can't be emotional. It has to be systematic. It has to be a protocol.
The adjustment process is methodical. Step 1, you isolate the threat. You do that by closing only the tested short strike. Step 2, you keep the corresponding long option. It now acts as a cheap directional hedge. Step 3, you close the profitable untested side of the structure completely. And step 4, this is the key. You use the profit from that winning leg to finance the loss on the tested leg. This is institutional risk transfer. You're using the trade itself to pay for its own defense. Okay, Section 5, the volatility business. To run this framework, you need a very specific operating philosophy. Consistent execution demands a shift in mindset. You have to move from thinking like a trader to thinking like an operator.
Let's be perfectly clear. You are not a gambler placing bets. You are an operator running an insurance business. You systematically collect premiums for taking on defined, manageable risk, and you do it over very short durations.
The system is just a repeatable loop. It's simple. You collect premium when the conditions are right, you manage risk according to the protocol, you exit early to realize the profit, and then you repeat. That's the entire business model right there.
And that brings us to our final section, the protocol on risk and suitability. To wrap this up, we need to address the mandatory risk parameters for an operation like this. First, a mandatory note on suitability. The strategy detailed in this briefing is absolutely intended for experienced traders only. This is not for beginners.
And finally, here is the full disclaimer. Options involve a significant level of risk and are just not suitable for all market participants. Any trade should be defined risk structures, and they must be sized appropriately according to your own risk management plan. Please remember, all of this content is for informational and educational purposes only. It does not constitute financial advice.